Good afternoon, everyone. I'm really glad you could join us for today's webinar, which is titled Mission and Money, the Importance of Investment Policies for Nonprofits. For those of you that I haven't had the pleasure of meeting before, I'm Mike Shaw. I'm a partner here at Sachs, where I lead the firm's nonprofit practice. I've been working with nonprofit organizations for my entire 25 years in public accounting, and I know that a lot of nonprofit leaders, like those of you that are joining us today, are always working on that difficult balancing act of managing your organization's resources and investments wisely, while also staying true to what's most important for any nonprofit, and that's the mission and serving the mission best. And that's what we're here to really talk about over the next hour. Just to move on to our agenda slide, as you can see here, we'll be digging into a number of different ways that you could start to think about your investment policies and strategies that goes beyond typical investment risk management, where hopefully you can have everyone thinking about how those strategies and policies can enhance donor trust and expand different giving opportunities for your nonprofit organization. Joined today by Bill Connor, who's a partner with Sachs Wealth Advisors. Before I turn it over to you, Bill, I want to just mention to everyone joining us that while it's an online format that we're doing today, we want this to be as interactive as possible. Some of you asked some questions in advance, which Bill and I will try to weave into our conversation and presentation. But if you have questions, if anything that Bill or I say during the presentation that sparks a thought or a question, drop it into the chat or the Q&A through Zoom. We're going to look to engage those throughout the hour that we'll be talking about this topic. Bill, I'll turn it over to you. And since some of the people that are viewing through the webinar may not know you yet, maybe just tell us a little bit about yourself, and then we'll get things underway.
Sure, great. Thanks, Mike. And thanks everyone for joining us this afternoon. As Mike mentioned, I'm a partner here at Sachs on the wealth advisory side, and been doing this for over 20 years now, hold the CFA, CFP designations, and work with a number of different types of clients, one subset being folks in the endowment and different types of foundational spaces. And really for today, want to be a resource. So as Mike said, any questions anyone has, please raise your hand. We're happy to address them. But hopefully this will be useful. We're really excited about sharing some of the best techniques with you guys. And so the first thing we really want to kick things off with was being, quote, donor friendly. Yeah, in this environment where you've seen decreasing government funding and grants being cut in various different ways, a lot of the nonprofit clients we speak with are looking for other ways to be able to supplement their resources. And one of the big ones, of course, is being able to find either new dollars from existing donors or hopefully new donors as well. So we want to share just a couple of techniques that we found have been very helpful for some of the others not-for-profits that we work with and being donor friendly. First and foremost, I think transparency and communication. And this shouldn't be news to anyone on the call. I'm sure that most of you are out there providing this type of transparency and communication. But ultimately, as a donor, you want to understand what the impact of your money is going to be and where is it going. And it's an area that I think is somewhat underutilized when you think about being able to create more donors, or as I said earlier, getting additional funding from these donors, is simply being able to tell people where their money went. What did it do? Giving some real world examples. And it's something that when you tend to see that type of communication, it does tend to resonate with those donors. And all things being equal, is likely to make them donate again. Say, wow, my donation really made an impact. And then, of course, there's the financial side of this, which is, there's been a lot of press spilled over the last several years here about what's the proper amount of amount for overhead versus going directly into programs. And of course, you need overhead to run any kind of organization. But there's been a lot of talk amongst the donors around where's my money going and what's the appropriate percentage of that. So being very clear about where the money is going, how it's being used, is, first of all, donors just want to see it. But it's also something, again, makes donors feel like they have a real insight and understanding of where their money is going, which makes it all the more likely that they're going to want to give again. So this is just one of the key things. And I think the kind of simplest thing I've seen that's been so impactful is newsletters. It doesn't need to be every week or even every month. or even every quarter sometimes, but annual, biannual, quarterly, letting people know what's going on. It does take a little bit of work, of course, but it's something that tends to be fairly low cost for a lot of organizations. You give the update and you send it out to your donor list, and the impact of doing that has multiplied many times over. And that's the one thing I always tell people to listen. If you're not doing a newsletter, make sure you get that out there. And again, within the context of transparency and communication. Actually, could you go back to the last slide, please? So a couple other quick things here. Number one is giving flexibility. So most organizations are well equipped to take donations of cash. If I'm going to put my advisory hat on for a moment, though, and I'm talking to a high net worth individual, I'm going to tell them don't give cash. That's a tax inefficient way to give. As a investor, especially an investor that may have embedded capital gains where they would owe a tax if they sell, by sending it over to a 501c3, of course, there's no taxes due when they sell, and there's a tax write-off. So as an advisor, you want to be giving appreciated stock, real estate. Donor advised funds are a little bit different, but in that similar vein of marketable securities. So it's important to be able to accept those things. Simple things like having a brokerage account in the organization's name. Many times you don't see that. So even if you had someone who said, "Hey, I really hit it rich on NVIDIA here, and I'd love to give you guys some of that to share some of the wealth that I've been able to create." If you don't have a way to receive the shares, it doesn't really matter much. So simple things like that, like making sure you've got a good quality bank account that's giving you good interest on your reserves, making sure that there's ways you can accept things like stock. Real estate becomes a little bit more challenging, simply because it is so illiquid. Many organizations are going to have policies around not accepting real estate because there's a lot of cost to liquidating it. So that's something you have to think about and understand. What does that cost? Are we able to manage that kind of thing? But for many people, that's going to be a challenge to, especially for smaller organizations, to be able to accept. And of course, the new one these days is cryptocurrency, which, from an investment perspective, it's had its runs and it's had some tough times as well along the way. But there's also a lot of people who have made a tremendous amount of money investing in crypto and would like to be able to gift that to different kinds of organizations. And that's something I think when you look at, again, just having a brokerage account to be able to accept those stocks, similarly setting up different types of organizations so that you can receive the crypto and be able to then sell that immediately. And we'll touch on this in the IPS, investment policy statement conversation a bit later. What do you do with that crypto once it's received? What do you do with that stock once it's received? Because there's different views and different techniques that you can use. But ultimately, you want to give your donors the flexibility to benefit your organization in the way that works best for them. And
Yeah,
sometimes it's just going out. Go ahead, Mike.
and Bill, I was going to say, just to kind of touch on that, because I know a lot of nonprofit organizations, they are concerned about holding those types of investments. But just to reiterate what Bill said, and he'll get into it a little bit later in his presentation about the policy of what types of investments are prudent for the nonprofit to hold. But it's very important for nonprofit organizations to think about ways to make sure that they are prepared to accept those types of donations, whether it's crypto, whether it's different, alternative investments, so that, as mentioned, investors that have seen significant gains this year and maybe in position to want to contribute those to nonprofit organizations are ready to really kind of reap the benefits of that. So making sure we're kind of clarifying, that there is a difference between what we're willing to accept as a nonprofit and what we're, kind of saying is prudent to invest in, as part of the portfolio.
Yeah, that's a great point, Mike. And certainly just because you receive something doesn't mean you need to hold on to it or it should be part of your investment portfolio. And I'm definitely going to touch on that, a little bit later as we walk through that. But these are all some of the considerations you need to have when you're accepting these different kinds of gifts. Donor advised fund grants are a little bit different. Those are oftentimes these donor advised funds are going to be run by large financial institutions like Fidelity, for instance, has a very well-known DAF, as they call it, donor advised fund. Effectively, most 501c3s are going to be eligible to receive those kinds of donations. You would want to make sure that the organization bylaws allow that. But certainly that is becoming increasingly popular way for wealthy individuals to gift. It allows them a lot of flexibility over their timing and amounts. So if you're not familiar with those things, definitely worthwhile to get familiar with it. Certainly happy to be a resource on that front. And then, of course, kind of maybe a bigger cousin to that would be the charitable remainder trusts. Those are other types of uh, accounts that have a charitable beneficiary at the end of a particular term. Understanding how those work and how you might be able to benefit from those, again, creates more optionality for your organization to receive these donations. So I also want to touch on aligning the investment mission. This is an area, so I've been in the investment space for going on, I guess, 24 years now, so older than I'd care to admit. But one of the things you've seen over, especially over the last 10 years, has been the real strong emergence of sometimes referred to as ESG, but effectively it's a values-based investment approach. And when you say values based, that's a term that can mean many different things to different people. And it's important to understand, what that really means. ESG, E stands for environmental, S for social, G for governance. And it's really an amalgamation of different areas and different styles of investing. But the commonality or the common thread with all of these, it's trying to align the way people are investing with things that are important to them. And if you're thinking about, I'll use a fictitious climate change oriented organization, perhaps they don't want to invest in carbon oriented businesses like oil extraction companies. That's not an outrageous thing to think about. If there is a particular thing that's important to your organization, there may be ways to align the investment policies so that you are benefacting those types of themes or whatever is important to you. But this is an area that's really come a long way. When I first started doing this in the early 2000s, there was basically just a couple of mutual funds out there. And it was really hard to find anyone who would create a customized portfolio for an organization. Whereas now you definitely can find that. My business partner here at Sachs Wealth, Jennifer Leong, holds a designation that's specifically focused on ESG investing and has been able to work with a lot of folks to implement, again, aligning their investment with their mission. And not something that's required, but I have seen an increasing desire from a lot of organizations to be able to do that. And then finally, this kind of dovetails with what we touched on earlier. Make it easy. Make sure that there's easy ways for people to track what's been given. That there's ability to give you some ideas on guidance and legacy planning and things like that. But the last thing you want to do, of course, is create any barriers for people to be able to give to you. So this is by no means an exhaustive list, and certainly when we have these kinds of consulting conversations with folks in the not-for-profit space, these are certainly some of the conversations that we'll have, but they're not going to be the only ones. And every organization is different in their scope and their needs and what the case might be. So it does become a very personalized type of approach and making sure that you're best setting yourself and your organization up for future success. I'm going to just pause for a second. I know we had a couple questions that were already submitted earlier, but I don't know if there's any popped up in the chat, or Mike, you want to maybe take a look at some of the ones that were submitted earlier.
Yeah, just to address a few that just popped into the chat, and I'm not sure if this came in right before or after we discussed it. Someone asked, is crypto something that nonprofits should not accept? But just to clarify, we certainly think nonprofits should have a policy to accept it. We'll go into a little bit later a bit as far as, and that's more into gift acceptance, types of gifts that you will accept. We'll kind of talk about investment policies, which will talk about what types of investments you'll want in your portfolio as part of an investment policy. And we're not necessarily recommending that as part of the investment portfolio, but we certainly think that organizations should ensure that they have a way of accepting those types of gifts under a number of different platforms that are available. I also saw a question regarding impact. Is there still a ratio on functionals that donors are looking for organizations to hit? I think it varies a little bit within the various sub-industries of nonprofit in the nonprofit sector. I think certainly getting above the 70% ratio is key with a lot of the ratings agencies. I think donors, depending on the type of donor, Still want to see closer to that 75 to 80% ratio. So just to go to Bill's point earlier, as far as communications with donors, those are some of the numbers that are not any requirements, but that will pop out for donors if something is particularly low. Bill, one of the questions that came in, prior was just about, how easy it is when you're looking at the mission aligned investment portfolio. It is to balance that with the need to actually, drive, a good investment return, and how difficult does that become? What does that require of an organization?
Yeah, I mean, listen, anytime you're excluding areas of the investment universe, you have the potential to reduce your return. I mean, that's just the bottom line. Having said that, there are plenty of other investments and opportunities to make money that oftentimes can do, as good as the broader markets, or sometimes even better. And really, this starts to come down to, what's your organization? What is the mission behind that organization? And if it becomes a situation where you're, you know, effectively cutting out everything, of course, there's nothing left to invest in. My experience has been that there are typically, specific issues that folks would like to avoid, or maybe more commonly, just an overall approach that is taking some of these things into consideration. And that's really what I see often is like, listen, I get, you can't, nothing is, the white as the driven snow or whatever they say, but you look at these things and you say, okay, how can I make this more aligned with my mission? And a lot of it just comes down to being aware and thinking about, what's important to this organization. And of course, you're not going to be able to catch everything, but by inserting that into your process and planning and thinking about how do you invest this money, what do you do with it, it oftentimes is going to lead you down a path that allows you to create this portfolio that does avoid some of these areas that you might want to avoid, and at the same time, it's going to give you the returns that you need to fund your goals. And ultimately, as to what that looks like, these end up being very customized portfolios depending on the specifics of an organization. And I'll share a real world example. A client of mine who's an animal rights advocate wanted a portfolio that had no animal testing involved in it. And so we went through and created a portfolio that had, now you can't say guarantee, but we went through and eliminated as best we could any of these companies that were involved in animal testing.
Great. Um, so, I think we'll, for now, no other questions have popped into the chat. So we'll move on to and go now into some considerations for investment committees and investment policies.
Yeah, and this is an area that can be tricky. Sometimes you'll find folks who are on the board who don't have a background in finance or investing, or maybe aren't as up to date as kind of newer opportunities might be. So when you start thinking about these things, the first and foremost, of course, is you need to act in the best interest of the organization. Now, you might think that was table stakes, but as Mike was kind of referencing earlier on, how much you go to programs versus overhead, that's not always going to be the case. And it's something that you want to make sure that the board and the folks who are involved in the investment committee are due diligence and care. You'll hear these terms commonly sprinkled out a lot of these conversations. But first and foremost, act in the best interest of the organization. Second, liquidity planning, right? So this is one of the big areas I found that not-for-profits can run into trouble. So you receive a nice chunk of change in a donation, and you use it all up in the first 6 months, right? You don't think about that next 6 months or the year after that. So as you have donations that are coming in, and most organizations, if not all, of course, have budgetary constraints that they're dealing with, but also have some view into the future of what donations are coming in, and you try to match those up as best you can. But ultimately, this is where the first step beyond having just enough cash to fund your operations, which is always the first and primary need for these funds, is like, let's get the operation moving. But once you've kind of got past that, short term, I've got enough money for the next 60 days kind of stuff, and you start thinking about, hey, I have a little extra here. What do we do that? What do we do with that? And that's when we want to start thinking about kind of different buckets of money. And the first thing I always tell people is prepare for that rainy day. I guarantee there's going to be a time for whatever reason that people aren't going to give. Maybe it's a recession, maybe something's changed in the laws, who knows? But there's going to be a period of time where you're expecting to have donations come in and they don't materialize as you would have expected. So having that liquidity reserve, which is usually how I like to have it, and this is not going to be invested for growth, probably in something like a money market, very low risk, give you a nice, nice interest rate if you can get it, but primarily is there as a reserve. That's going to be the first step when you start thinking about building out an investment portfolio for any not-for-profit or frankly individual. Got to create that reserve fund first and foremost. As you've moved past that and you say, listen, I've got 6 months of cash in reserve now, so I feel pretty comfortable about maybe layering out some more of this, or maybe it's a year. This is going to vary from organization to organization. And one of the conversations that really should be had at the board, certainly at the investment committee. But let's put to this side, we have enough in reserve, we're comfortable, we have the money that we'd like to see. And so then you start thinking about, okay, what else can we do? How can we grow this money? And that's where you want to be thinking, up MIFA. So you're thinking about what are the regulatory compliance aspects of this and making sure that you're operating consistently within the framework of a not-for-profit and making sure that you're obviously following all the different laws that are there, and also starting to think about that longer term. How do we grow this money so that it can be there for future needs? Ideally, if you have enough, you get to a situation where you have an endowment, and then you can use the earnings from that endowment to fund your needs and goals. Now, this may be aspirational, and not everyone has enough to get to that endowment level, but ultimately, when you look at the not-for-profits that have lasted, not for 5 or 10 years, but for 100, it's because many of them have had these endowments that have allowed them to get through the lean times that are inevitably going to come. And if you can get to the point where you have an endowment that's just funding, let's just say it's funding one program, but the income that's kicked off of that chunk of investment dollars fully funds the program, well, then that thing can live on in perpetuity. And that ultimately, for many of these not-for-profits, is the ultimate goal. And it's somewhat aspirational because for many folks, it's just, hey, I got bills to pay and I got to get through that right now.
And Bill, you mentioned aspirational, but I think sometimes nonprofits fail to realize that just because they haven't received an endowment gift doesn't mean that they can't use accumulated kind of growth in their cash account to create their own board designated endowment. And that
Absolutely.
there's sometimes this fear that if they have built up a reserve, that donors are going to look at them, or even the IRS is going to look at them and why aren't you spending this? It's perfectly prudent, and it's even it's codified by law that nonprofits can establish these longer term investments. It doesn't need to be a donor restricted gift that establishes an endowment for nonprofits to very prudently build up these reserves to think about the long term growth. So I know it wasn't a specific question that was asked in the chat, but I do often get questions: Are we allowed as a nonprofit to to invest? And it's certainly very prudent, and it's the right move if you have these reserves built up. And it even shows donors, that there's a plan. I think a lot of times, if it's it doesn't need to be a spend it all or have it sit in cash mentality. Getting it into the improper investment vehicles shows future donors that and maybe even kind of prevents donors from giving restricted gifts if they see that actually the board of this organization, the management of this organization knows how to reasonably spend down gifts over time, and that could lead to larger gifts that aren't restricted if donors have that confidence that there is a plan and a strategy in place for the long term.
Yeah, absolutely. I can't stress that enough, is that most donors, when they see that, they're not going to look at it as a negative, but as in fact a sign of a good, strong organization. And that is ultimately when you start thinking about, what do donors want to see? They want to see that their money's being put where they said it was going to be put. And part of that is going to have the confidence that the organization is going to be there. And that certainly leads to more of that. And the last thing I'll touch on here is risk management, because it's an area that, especially if you don't have, people on the board or in the organization that have a background in investing in finance, it's an area that can be somewhat intimidating. And the kind of knee-jerk reaction for most people is we're going to keep it super safe, right? We're going to just keep it in cash, which, there is, some safety in cash. There's also a risk in doing that. And You think about the inflation we've seen in the economy here in the US the last couple of years, that has significantly reduced the purchasing power. So someone who had money sitting in cash in 2021 has seen a significant reduction in what that cash can buy, over the last 4 years. So the real key with this is not just putting it into one thing, but trying to balance the different risks that are out there. Because the reality is there is nothing that's risk free. There's always going to be risks that are out there. And the only way I've seen in 20 plus years of doing this to really mitigate those is to try to balance them out in different ways.
And so, Bill, one of the questions that came in as part of the registration was if if you're a CEO, if you're a CFO that does want to proactively, and thinks that the organization is at the point of being able to, start to develop an investment portfolio, but you have a board that is just, you know, fiscally, just doesn't see that that's prudent. What are some of the initial steps that CFOs, COOs, CEOs can start to take to get their board to kind of feeling more comfortable with moving forward with an investment strategy?
Yeah, I think it's first of all making sure that we have a high degree of confidence that our programs are funded, right? So that's the first step is showing people like, listen, we have the money to fund these for the next 18 months, whatever the case might be, right? And understanding that most people I think get the idea of a rainy day fund is some term most people are familiar with, and you can look at periods of time, whether it's say 2009, 2010, where the economy was not in great shape, and the fundraising dropped off a cliff in that environment. And so pointing to those kinds of environments and understanding that they're cyclical, it's not a once in a lifetime kind of thing, but something that happens on a regular basis, and that the way that you can protect the organization, and that's ultimately what we're talking about here, is taking steps to protect the organization during some of these lean periods. A lot of times that tends to resonate when people say, oh, I get it, I see why we want to have this. And then the other big thing is, engage with folks who've done it before, whether that's someone like myself or Mike, who can provide kind of an outside view and share. Listen, we work with a lot of different folks in this space. And let me tell you about some of the other folks. Obviously, we're not going to give you their names or anything, but let me tell you about some of the other folks there in the space, and the kinds of things that they've done as similar organizations. So you start to open up people's eyes to some of the possibilities there, around these different kinds of things. Ultimately, it comes back to that first, which I think is, communication and transparency. We are doing this because we think it's in the best, the excuse me, the best for the organization going forward.
And then kind of following that, so if you've got a board that okay, they've agreed to move forward, what type of information is good to provide, let's say, a board rather than an investment committee, so that they don't feel overwhelmed, they don't necessarily feel scared about being on the board, or or being aware of the investment activities? And what are some some general information or general tips that you can give to the management of organizations?
Yeah, I think this is something we do personally, is just making sure that there's regular communication from us back to them around what's happening in the accounts and the portfolios, and keeping people abreast of what's happening. Okay, the Federal Reserve cut interest rates. That means your money market rates are probably going to be going down over the next 6 months. Maybe it's prudent to think about other places for your money. But ultimately, it really just comes down to communication and making sure that your people are aware of why the mission is there, and how we are using these investments to further that mission. All right. So, um, as you might guess from my background, I'm here in New York City, and you can see this is the Uniform Prudent Management of Institution Funds Act. Okay, for those folks who are in the state of New York has its own version of this, but very similar, right? And I think when you look through these, there's going to be a commonality here, which is putting the organization first. This is a bunch of different ways to say that, but ultimately, that's really what this comes down to, and acting prudently and in good faith. So prudent is a word you're going to hear over and over and over again, and it's somewhat subjective. But ultimately, it's about total return approach, as you can see there, and making sure that's aligned with the spending policies, and having written spending policies about what these things what these funds are going to be used for. And then usually where I come into the mix is helping to establish a written investment policy. And again, this is doesn't like to be set in stone. Oftentimes I say, think of this as a living document we should revisit annually, biannually, depends on the organization, or when there's a big donation, right? Because that can really change things. I've seen that happen before where, you know, the one right now, of course, is Mackenzie Bezos's ex-wife, who's given away billions of dollars, no strings attached, and has really changed for a lot of these not-for-profits, changed their future. And so when that happens, of course, you want to make sure that there's already a policy in place for the investment and monitoring of these different things. Um, Document everything. I can't stress this enough. You want to talk about donors and making sure that people feel comfortable with the organization. If you have documented investment committee board meetings that go back, however many years, that is the kind of thing that builds confidence for donors. And then finally, consider using professional expertise. If you have folks who are in the organization or on the board, who have a background in finance or investing, great, lean on them. If they don't, it is a prudent use, here's my word prudent again, here's a prudent use of your company or, excuse me, not-for-profits funds to engage with someone who's going to help you set things up for the future in the best way possible. And ultimately, again, you take a look at all of these different things and making sure that you are thinking about the organization first and foremost, before anything else. It's not about the investment return, it's about what that return does for the organization.
Yeah, and kind of sticking with we go just back up to that other slide. I think the things that are outlined here, I think walk through a lot of things that our nonprofit attendees today are thinking about. I know we talked earlier about whether or not to have, let's say, something like crypto in your portfolio, but maybe Bill, maybe kind of inform people about how that investment policy could outline, what the investment, strategies are going to be and what type of risk the organization is kind of willing to take, and how developing that policy can, lead to, or prevent issues down the road with those types of decisions.
Yeah, absolutely. And crypto is the kind of topic du jour. But I think, broadly, any growth asset is going to kind of fall in that same bucket, which is, if there's potential for this thing to go up, but there's also potential for it to go down. And as an organization, do you want to take on the risk of seeing that asset, whether it's a stock or crypto, go down in value? Most of the time, the answer is no. We know what we got. We know what it's worth today, and we want to turn that into dollars that we can use, for our programs. And ultimately, specifically with crypto, the recommendation, has been, and I think continues to be, it's far more widely accepted today than it was just even a handful of years ago. But the reality is, it's incredible. Bitcoin was 60,000 last fall. It's 120,000 or so right now. Um, Great if you bought it last year. Buying it now, maybe not, and you don't know, and you don't need to take on that risk. So with crypto specifically, our advice has been, yes, we will accept that as a donation, but our policy is going to be to sell that as soon as possible. We do not want to take on the risk of seeing that go down, even if it's at the expense of the possibility of seeing it go up a whole bunch, right? Stocks are a little bit different. Stocks are something where if you have an endowment or a brokerage account of some sort, and you again are thinking about longer term growth, maybe it's not prudent to sell everything. Maybe it's maybe it's Apple stock. Apple's a great company. I want to hold on to it. At what percentage, at what level? That's where you start taking a look at the specifics of your organization, and it may be prudent just to sell it. Right? Again, this is where the specifics of each organization are going to dictate what makes sense from an investment policy perspective. But that's a little bit different, where it might say, hey, we got 1,000 shares of Apple. We're going to hold on to 100 of these and liquidate 900. 100 goes into our long-term savings account, however you want to call that. And the rest gets liquidated right away. Again, this is the kind of thing that needs to have some thought. Most organizations, to be clear, are not doing that. They're just liquidating immediately. That is, I would say 9 out of 10 that I've seen, they receive the donation and immediately, as soon as possible, they're liquidating. And I've had accounts like this where, you know, so and so church donates, and all of a sudden they're calling me up and saying, "Hey, we got this donation from a parishioner. we need to sell this right away, right? So that's by far the most, but I also encourage people to think, especially if we're thinking a longer term. And again, we've taken care of the emergency fund and you've got the funding needs set up. You can hold on to some of it as long as it's a good company and it's done prudently. This is where I think having that professional expertise can be very helpful.
Yeah, and remembering that these investment policies, they're living, they're breathing. They can be updated based on really where the organization stands. But I think what it does is it sort of anticipates things down the line. So okay, when these policies can outline at what point do you move to riskier investments, and what type of risk tolerances the organization have. It can outline the makeup of the portfolio so that doesn't need to be a monthly decision. That could be something that's updated by the investment committee or the board periodically. But those types of decisions should be outlined in the policy so that everyone on the board is really comfortable with the way the organization is going to invest, and what type of risk it'll take at different levels of accumulation.
Yeah, absolutely. And I think the ultimately when you think about the spending policies and all that stuff, all this stuff needs to be written down, right? And to that point, Mike, I think that also needs to be written down. How often do we review the investment policy statement? How are we going to evaluate? Is it working for us? But I encourage everyone to think about these things at least annually. And it doesn't mean you change it. And as I say it that way specifically, think about it doesn't mean you necessarily change it, but you got to pull it out, take a look at it, and say, this is what we came up with on July 30th, 2024. Is this still relevant for our organization today? How have things changed in the last 12 months? Well, nothing's changed. Everything looks great. Okay, we're going to stick with this. Or, well, we merged with this organization, or we had this donation that's really changed the outlook. Um, there's different ways that might happen, but it's important to regularly revisit your investment policy statement to make sure it's still aligned as best it can be with your mission.
Great. And then another frequent, and if you could just leave that slide up, because there are a few other items I just wanted to kind of that kind of lead to some questions that have been asked. That number 4 total return approach. A lot of times nonprofit organizations, think that if there's a down year, it's going to kind of, mean that they can't spend, out of that, investment portfolio. Bill, can you maybe, just share your thoughts on that and kind of,
Yeah,
discuss how a proper policy can address that?
yeah, absolutely. And this is, I think, a common misperception I see, and it's not just with non-for-profits. Many people feel this way, which is that the way to manage risk is to be ultra conservative and not take on anything that might drop in value tomorrow, right? But the reality is that there's risk in doing anything. And there's risk in doing that, primarily what you call purchasing power risk, which is basically, the value of your dollar declines because of inflation over time. And as I touched on earlier, you've seen that in the last couple of years. Go look at the price of eggs, right? And you see many organizations have come to realize that the best way to mitigate these risks is to balance them and have, yes, you're going to have some short-term stuff that's in cash or cash-like type instruments that you're not going to see fluctuate on a day-to-day basis. But over time, you're going to lose value with that. So you need to have something that can keep pace with inflation and grow for you for the future and help to mitigate that risk of inflation. Now, how much in each bucket, how much in each category? Again, this gets back into understanding the specifics of your organization. But the reality is that as this space has evolved and as the finance world has evolved, people have recognized that the total return approach is a more prudent way to think about managing money than just being saying, you can't. It used to be you would see like stuff like this. You can't buy stocks and you can't invest in options or real estate. So what are you left over with? Cash and bonds. And they just don't keep pace. They just don't do it. So, especially over the last 25 years, I think you've seen many people move away um, from that type of approach and talk about more being, what would a prudent person do? Because that gives you some flexibility to think about not just the risk that the stock market goes down tomorrow, but the overall risks in dealing with these funds and these endowments.
Yeah, and that's really the history of the act itself was, I think, a lot of nonprofits after 2008, which is really when the act got, its movement, and MIFA in New York, got its movement, was that there was really just the thought that, let's just put it in cash because we can't spend if it falls below, historical dollar value when it came to uh, donor restricted endowments. But the law specifically outlines that, as you mentioned, prudent. If nonprofits have a spending policy, they're following that spending policy. It's a prudent policy that any year-to-year losses will, eventually recover, so long as the kind of the corpus is not, being spent down at an unreasonable rate. So it's important for nonprofits to understand that. They can budget for their spending from the investment portfolio, year to year, and not be worried about any specific, year to year downturns, as long as, it's outlined in the policy. And as you mentioned, is they should be documenting, their decisions on an annual basis, specifically when it comes to the appropriation and the spend down from their investment portfolio. Um, uh, Bill, as we kind of, and someone actually just sent a question. Do we have sample investment policies that we can share? So, Bill, don't know if you want to speak to that, or I could address that as well.
Yeah, I mean, there's outlines. Is usually how I have things. It's not necessarily specifically, written in Word format, but there's certainly outlines that I use to kind of give people the outline of what's needed there. So that's usually how I've started with things, because there can be large differences between different organizations, and they can be a little bit different. But if you have that outline of what should be in there, frankly, based on what we're looking at here on the screen, that oftentimes is going to be a really good start. And then, of course, you can tailor it to your own specific needs. And that's ultimately what this is all about, is creating a document that makes the most sense for your specific needs. I say your organization's needs, such that, it's there and you have something you can kind of fall back on, over time. But the way to get started with that is, at least in my experience, has been kind of using an outline format rather than a specific, written template, because there are such differences between organizations.
Yeah, I agree. I think if depending on your organization, if you think you're still, kind of a little bit away from having, any significant, investment portfolio, I think then some of the kind of the standard templates are okay. I think if you've already got investments, and you're thinking a little bit more strategically, I think it's probably good, as you mentioned, Bill, start with an outline, and sit down, either with your investment committee, with an investment advisor, to really, come up with a more comprehensive plan. There are certain things that should be specifically outlined. Again, as Bill mentioned, a lot of these are right here on the slide. For those of you that are in New York State, the New York State Attorney General's office has an excellent resource that answers a lot of questions about what should be in an investment policy. So there's certainly things that we can share, but I would think you'd want to kind of do a deep dive into it if you've if you're close to or already have a significant investment portfolio. Bill, it looks like we have about just a couple of minutes left. Any, I haven't seen any further questions come up specifically during the chat. I have one or two that I could touch upon, but wanted to see if you had any final thoughts that you want to just share with those that joined us today.
Yeah, sure. I think ultimately the biggest piece of this is communication, communicating with the folks within the organization, communicating with the people on the board, and having these conversations around these things. If you're not talking about it, you're never going to get to where you want to go. So the first step, when asked earlier, was the first step, have a conversation, right? Make sure that this is part of a regular conversation at the organization. And Mike touched on this earlier. You never know when something's going to come in, right? So you might not necessarily have a need for this today or even tomorrow, but thinking through these things and being prepared, so that when you do have that conversation, you say, yeah, we are ready for that. Here's why. That can make all the difference in making sure that you're going to be able to secure, those different kinds of donations. And don't be afraid to use resources. I think that's the other thing. Sometimes folks are saying, "Oh, I'm just this not-for-profit." Well, we've got a ton of resources here at Saks. There's other folks. I can make this a Saks commercial. There's other folks out there as well who can help you. But certainly myself, Mike, we're available as resources. Um, and again, the first step is always the hardest. So that's usually what I say is, just start that conversation.
Yeah, and Bill, as you mentioned, it's probably the donors that you don't have that, if you don't have an investment policy, you should start thinking about it. You should, get it in place as donors, consider these non-cash gifts. They're gonna, ask about whether investment policies have been established. Larger foundations that you might be applying for grants for the first time. They want to see that investment policies are established. So it's not necessarily about the what you have today, but it's thinking about how you can attract tomorrow's donors. As Bill mentioned, reach out to those of us at Saks as a resource. Even it's the first step, get conversations going. A question came in. Yes, the slides will be available. This is being recorded as well. So, if there's things you didn't catch or if you joined late, we certainly encourage you to watch that once the webinar is made available through the website. We certainly appreciative for everyone that joined us today. Here's our contact information. If you're working with other partners, certainly reach out to them as well. Really, Saks always wants to make sure that we have a wide range of different expertise. We always want to make sure that you're able to be in contact with all of us here at Saks. And again, thank you for joining, Bill. Really appreciate you sharing all of your knowledge on this subject with our nonprofit organizations.
Yeah, thanks, Mike. It was a pleasure, and appreciate everyone listening to us today. And as I said, happy to be a resource going forward.